Over the past 25 years, house prices in cities like Adelaide and Brisbane have grown faster than the Nasdaq. Read that again. Not the ASX. Not some sleepy Australian index. The Nasdaq, home of Apple, Microsoft, Nvidia. And on pure price growth, some Australian capital cities beat it. If that number surprised you, good. Because most people watching this have already decided which asset wins before they've looked at a single figure. Property people assume real estate always wins. Fire people assume US index funds always win. Both are working off numbers that have been quietly rigged, sometimes by accident, sometimes on purpose. This is Aussie wealth truth. And today we are doing the maths properly. Property versus US stocks, over 20 years, with every number stress tested, because the honest answer is more useful to you than the tribal one. Let's set the record straight on what we just said. That 25-year property number is capital growth only, the raw increase in home values, tracked the same way you track a share price. It is not the total return. When you add back dividends reinvested, the Nasdaq and S&P 500 look very different. There's a second distortion almost nobody mentions: currency. When commentators quote Nasdaq or S&P 500 returns, they are quoting them in US dollars. But you don't invest in US dollars. You invest in Australian dollars. Back in 2011 to 2013, the Aussie dollar was close to parity with the greenback. Today, it buys you roughly 65 to 70 US cents. That slide in the exchange rate means every dollar of US share growth is worth meaningfully more once it's converted back to Australian dollars. Quote US returns in USD, and you understate what an Australian investor actually pocketed. And it's not just the 20-year window that flips depending on where you look. In 2025 alone, the ASX 200 delivered a total return of roughly 10.3%, including dividends. National home values rose around 8.6%, or 12.4% once you count rental income. Shares won that particular year. The year before, property had the edge. This is the entire point. Whoever tells you one asset always wins is choosing their time frame to fit their conclusion, not the other way around. Here's the credibility anchor, because this channel doesn't do vibes. The Russell Investments and ASX long-term study puts Australian residential property at roughly 10.2% PU over 20 years, against Australian shares at around 8.8%. The S&P ASX 200 Accumulation Index, that's price plus reinvested dividends, has averaged closer to 9 to 10% per annum over recent decades. And the S&P 500, in US dollar terms, has averaged around 10% annually since the 1950s, closer to 11 to 13% over the most recent decade. Layer the currency effect on top of that, and Australian investors holding unhedged US shares have done better than the headline USD number suggests. So why does property still look unbeatable in most comparisons you've seen online? One word: leverage. Let's actually walk through the mechanics, because this is where most content waves its hands and moves on. Say you buy a $500,000 investment property with a $100,000 deposit, an 80% loan. The property grows 10% in a year. That's $50,000 of gain. But that $50,000 isn't measured against the full $500,000. It's measured against your $100,000 of actual equity. Before costs, that's a 50% return on your money. After mortgage interest and running costs chip away at it, real-world estimates land closer to 35%. Compare that to an unleveraged share portfolio growing at the same 10%. Your return on your own money is exactly 10%, full stop, because there's no borrowed money doing extra work underneath it. That's the entire leverage effect in one sentence. The bank's money is doing a third of the growing, and you're keeping all of the upside. But leverage isn't free, and this is where most comparisons stop telling you the truth. Let's build two real paths, side by side, over 20 years. Path A: you put your $100,000 down on that $500,000 property, borrowing $400,000. At current lending rates, that loan costs you roughly $24,000 a year in interest. Rental income at a typical yield brings in around $20,000 a year, and after rates, insurance, maintenance, and property management fees, you're left with maybe $15,000 net. That leaves a shortfall of about $9,000 a year, roughly $750 a month, coming straight out of your own pocket, whether the market moves or not. Grow that property at the historical property average of just over 10% a year for 20 years, and, ignoring loan principal repayment, taxes, and selling costs for simplicity, your equity could realistically compound into several $1,000,000, largely because the bank's $400,000 has been compounding alongside yours the entire time. Path B. Instead, you put that same $100,000 into a low-cost, globally diversified index fund, and instead of paying a mortgage, you dollar-cost average that same $750 a month straight into the market. No tenants, no repairs, no phone calls. Compounding at a comparable long-term average. That combination of a lump sum plus steady monthly contributions grows into a meaningfully large sum over 20 years too, genuinely competitive with Path A, just without the leverage multiplier, and without ever needing to survive a vacancy, a rate rise, or burst hot water system. Path A can out-earn Path B in raw dollar terms, purely because leverage is doing extra work. But Path A demands that $750 monthly cash commitment for 2 solid decades, rain or shine. Path B demands the same monthly commitment, but not the mortgage stress, the tenant risk, or the 6-figure transaction cost of buying and eventually selling a house. Add franking credits on top of Path B's Australian share allocation, and its after-tax return closes the gap even further. So which one actually wins? Here's the honest answer this channel is built on. It depends entirely on which version of you is asking. If you have stable, serviceable income and can comfortably absorb that monthly shortfall for 20 years, leverage property can out-earn an unleveraged share portfolio on the same starting capital. If your income is variable, if you value liquidity, or if you simply don't want 2 decades of mortgage repayments tied to one address, a globally diversified share portfolio delivers a genuinely comparable return with zero holding cost and the ability to sell part of it next week if you need to. Neither tribe is right. The property crowd conveniently forgets to mention the interest bill. The index fund crowd conveniently forgets the leverage multiplier. Both are quoting a number that's true, just incomplete. Here's what this actually means for you. Don't ask which asset class wins in the abstract. Ask which one wins for your borrowing capacity, your income stability, and your appetite for a mortgage versus a sell button. The 25-year number that opened this video wasn't a lie. It was capital growth only, in a currency and leverage vacuum. Once you had total return, currency conversion, leverage, and holding costs back in, the picture is far closer than either side wants to admit. You don't need to pick a team. You need to pick the asset that matches the version of your financial life you're actually living, not the one influences are living for the algorithm. That's the truth the noise won't give you. Subscribe for more of it.